Then coming to the next one, revaluation of non-current asset. So generally, in subsequent recognition, subsequently, asset is valued either using cost model or revaluation model. So here, in case of cost model, asset is shown at cost less accumulated depreciation till the date. This is called as what? Book value. In case of revaluation model, the book value of the asset is compared with the fair value on the last date of the accounting year. Then the revaluation may result either in increase in value or it may result in decrease in value. In case of increase in value of an asset, for example, we calculated a book value of the asset. So total 1 lakh less 40,000 equal to 60,000 is the book value of the asset. This is the cost. This is accumulated depreciation. So here, then, then there are two ways. One is fair value of the asset is around 80,000 is. For example, 1,20,000 is the fair value. Or else fair value of the asset is around, for example, 35,000 is there. Two cases. Either it may result in increase in value or it may result in decrease in value. In the first scenario, the book value is 60, but fair value is how much? 1,20,000. Then we have to consider the value of the asset is equal to 1,20,000. In that case, how to write that increase? How much increase is there? 60,000 increase. That 60,000 is a transfer to separate account called as what? Revaluation surplus. In that case, we have to write the journal entry debit. So first remember that increase in value first adjusted to the provision for depreciation. After that, if any surplus available, then only that amount transferred to the cost. Then we write the entry debit provision for depreciation account, debit property, plant and equipment account, credit revaluation surplus account. Here the revaluation surplus 60. Then first transfer to provision. Provision for depreciation 40,000 is there. Completely rate of 40. Then the excess amount transferred to property, plant and equipment. Nothing but cost. Nothing but cost. Okay. Then in case of decrease in value of an asset, here the value is equal to how much? So 35,000. How much decrease? 25. The 25 transfer to statement of profit and loss. We have to write the entry debit property, plant and equipment account, credit debit statement of profit and loss account 25,000, credit property, plant and equipment account, how much? 25,000. These are the journal entries to be recorded in case of revaluation. So this is what first time revaluation. So generally the book value of the asset is compared with fair value at the end of the every year. Means we need to incur that review that revaluation at the end of the every year. And while reviewing it in subsequent period, it may result in either increase in value of an asset or decrease in the first year, increase in value. But coming to the subsequent period, it may be results in increase or decrease in value, right? So there are two possibilities are created to us. So coming to the subsequent. So two possibilities. So either increase or decrease, either increase or decrease. For example, so here we provide the depreciation. Here 1,20,000 is the, so useful life is 10 years more. Remaining useful life, for example, estimated 10 years. Then the depreciation is 12,000 first year. Second year, we provide the depreciation for 2 years. So nothing but what, 24,000. So 1,20,000 minus 24,000 equal to 96,000. This is the what book value of the asset. On this day, the revaluation happened. On this day, the revaluation happened. Again, there is an increase in value of an asset. So if the fair value of the asset is estimated as how much, for example, so 1 lakh is there. In that case also, that increase in value of an asset is transferred to revaluation surplus. So then first adjust that increase in value to the provision, and if any surplus after writing of the provision is only transferred to cost, nothing but PP. But here increase in value 96 minus 1 lakh minus 96 means 4,000. That 4,000 is does not sufficient to write off the total the provision for depreciation. So first transfer to provision only. Then we write the entry debit provision for depreciation account 4,000, credit revaluation surplus account 4,000. Revaluation surplus account how much? 4,000. Okay. Then coming to the decrease in value of an asset. Generally, what we discussed, for example, fair value of the asset is around, for example, 80,000 is 80,000. So what we discussed previously, in case of any decrease in value, transfer to the profit and loss statement. But here, don't transfer directly to the P&L. The decrease in value first adjusted to revaluation surplus, and later we transfer to the profit and loss. Then we write the entry debit revaluation surplus account. So how much amount is decreased in PPE? So 96 minus 80. Nothing but how much amount is reduced? 16,000. But in revaluation surplus, previously we have how much? 60. So sufficient amount is there. The total 16,000 transferred to revaluation surplus. For example, in revaluation surplus, sufficient amount is not available. Then first adjust to revaluation and the remaining amount transferred to P&L. So debit statement of profit and loss. But here statement of profit and loss 0, not required to transfer. Not required to transfer. So this is the revaluation cost model, revaluation model, subsequent recognition. So in case of cost model, we show it costless depreciation, revaluation. So is carried at what revalued amount less any subsequent accumulated depreciation subsequently. So two conditions subsequently made with sufficient regular to ensure that carrying amount does not differ materially from the fair value at the end of each reporting period. So coming to the accounting, restate the assets cost to the new valuation, either increase or decrease in value of an asset. Eliminate any existing accumulated depreciation for the asset. This is the first one. And after adjusting the accumulated depreciation, then only transfer to the PP, property, plant and equipment. And whatever the revaluation surplus, this is a journal entry. So whatever the revaluation surplus created in the year of creation, we have to show it as a other comprehensive income in statement of profit and loss and other comprehensive income along with that, and as a part of what equity as a revaluation surplus. In subsequent period also we have to show this revaluation surplus as a part of equity and till the asset disposal. So but In other comprehensive income, we have to show the revaluation surplus in the year of its creation. In subsequent period, not required to create. So recognition, already we discussed. Okay, in the increase in value of an asset transferred to revaluation surplus, decrease in value of an asset transferred to profit and loss account. Okay, so recognition of the revaluation gain. So the entity revalue its building and decides to incorporate the revaluation into its financial statement. So then extract coming to building cost depreciation. So then the building revalued on 1st January 2008, 114 lakh. So it is useful life, its useful life is 40 years. Then show the relevant extract from this financial statement at the 31st December. So how much increase is, so how much increase is there? So 14 lakhs minus 10 lakh 56,000, 3 lakh 44,000, 3 lakh 44. Then for that increase, we have to write debit provision for depreciation, debit building, credit revaluation surplus, 3 lakh 44, 1 lakh 44, 2 lakh. This is the journal entry. So then this is the journal entry, right? Then in this statement of profit and loss under other comprehensive income, revaluation surplus 3 lakh 44,000. Then in statement of financial position on asset side under non-current asset under PPE, we have to show the amount 12 lakh plus increase in building only 2 lakh. The remaining 1 lakh 44,000 affected to the provision, right? So 12 lakh minus 2 lakh, how much? 14 lakh. Less. We have to provide the depreciation again, right, for the year 31st December 2008. Then what is its useful life? 40 years. So this 14 lakh is segregated over 40 years. So 14 lakh by 40 years equal to 35,000. Then remaining amount is the book. Remaining amount is the book. But here this 35 out of the 35,000, the total amount is not transferred to P&L. This total depreciation generally, what is the journal entry for depreciation? Debit depreciation, credit provision. The depreciation transferred to statement of profit and loss, debit statement of profit and loss, credit provision for credit depreciation. Right? So that is the journal entry. Okay, so 344. Same, right? After providing depreciation. So this is okay. So here, in case of revaluation, any depreciation created due to the increase in value of an asset, due to the increase in value of an asset. So for example, the depreciation is 25,000 per annum regularly. So due to the increase in value of an asset, 35,000 per annum is created from the today onwards due to revaluation. Then generally we write the entry debit depreciation, credit provision for depreciation 35. So this is a journal entry for the current year. But generally this 35,000 transfer to P&L statement. But Out of the 35, 10,000 created because of revaluation, nothing but increase in value of an asset. So that additional depreciation created is a transfer to revaluation surplus, not to the P&L. Then what is the entry? Debit revaluation surplus, debit statement of profit and loss, credit depreciation. Total 35. Normal depreciation 25, regular created. But the 10,000 extra created because of revaluation surplus. So that's why we have to adjust that additional depreciation to the revaluation surplus. So any reserve maybe so revaluation for additional depreciation charged on revalued amount compared to the cost that is adjusted to the revaluation surplus. That is adjusted to the revaluation surplus. So this is the journal. Okay. So here this is the statement of profit and loss. Written. Okay. Then on 1st April 2000 X8. So on 1st April 2000 X8 fair value of X use property was 1 lakh with a remaining useful life of 20 years. X use policy is to revalue its property at year end. On 31st March 2000 X8 X9 the property was valued at 86,000 and the balance on revaluation surplus at that 1st April 20, which relates entirely to the property. And X does not make any transfer to realize the profit in respect of excess deficit. Does not make any transfer to realize the profit. Prepare the extract. Um, Prepare the extract. So of XU's financial statement for the year ended 31st March 2009 reflecting the above. Show the how the accounting would differ. The opening revaluation surplus does not exist. So for which year we need to create for the year ended 31st March 2009. So generally two statement of profit and loss and a statement of financial position. These two are there. In case of statement of profit and loss, in case of statement of profit and loss, we have to create what depreciation. We have to choose what depreciation. And one more thing is any revaluation happened during the year, that amount transfer other comprehensive income, right? So on 1st April, 1 lakh with a remaining useful life 20 years is there. So on 31st March 2018, the property valued at 86 means. So 1 lakh by 20, nothing but what 5,000. 1 lakh by 20. This is the depreciation. So depreciation 5,000. Next. Then book value is how much? 1 lakh 5,095. This is charge value to charge it to 86 compared with so revalued amount 86,000. Then how much amount decreases the 9,000. So how much amount decrease 9,000 that is transferred to so statement of profit and loss decrease in value of an asset 9,000. These are all charges, right? Then coming to the statement of financial position. So we have to show the property, plant and equipment at 86,000 at a revalued figures, right? At revalued figure at 86,000. Then this is on asset side. On equity and liability side, under equity revaluation surplus, already 20,000 balance is there. From that reduction in value 9,000 at first. Then the remaining 11,000 is shown. Remaining 11,000 is shown. Clear? So here this decrease in value of an asset, decrease in value of an asset, and sorry, this decrease in value of an asset is not required to transfer to statement of profit and loss. So because we have the revaluation surplus at present, the revaluation surplus opening balance is there. You have to adjust this amount to this account only. Don't transfer to statement of profit and loss. If stay revaluation surplus is not in existence, then transfer 9,000 to statement of profit and loss. So then that amount is transferred to equity. The say remaining is everything is same. Okay. Next to disposal. So coming to the disposal or sale of an asset, first calculate book value on the date of sale or disposal. Then compare that book value with net sales, and the difference, if any, is a profit or loss, which is transferred to statement of profit and loss. And on that day, if any provision for depreciation is, so this is transferred statement of profit and loss. For this, what is the journal entry? Generally, we maintain what cost is maintained in asset account. Provision for depreciation, we create a separate account called as accumulated depreciation account. Then first to transfer this accumulated depreciation to the asset. Then we use these entry. Then what is the journal entries required to be recorded here? In case of disposal, what are the journal entries? So first, debit provision for depreciation account, credit property, plant and equipment. First transfer the provision to PP. Then in PPE, we have book value. Generally in PPE, we have cost. We maintain it cost. Once we transfer the provision for depreciation, then in PPE, we have what book value. Then write the sale end. So in case of when this sale is made, then debit bank account, credit PPE account, and the difference if any. So in case of loss, statement of profit and loss account is debited. In case of profit, statement of profit and loss account is credited, right? And one more thing is, if any revaluation surplus available relating to the respected property we sold, that is transferred to retained earnings, we write revaluation surplus account, credit retained earnings account. Okay, so this is the profit or loss, and any balance in revaluation surplus is relating transfer to it. And this is very important. This does not affect other comprehensive income, because in other comprehensive income, revaluation surplus is shown only in the year of its creation, not in subsequent period. Okay, so this is about what revaluation.